Welcome back to the Real Estate Standard Podcast, episode 16, where commercial real estate and Bitcoin collide. My name's Tim Kotzman. I'm here with Chris Drizga, Kenny Alves, and this is the week of April 13th, 2026. Each episode here, we break down how serious operators, investors, and developers can stay competitive and profitable in the 21st century by examining commercial real estate through the lens of Bitcoin. On today's episode, we're comparing traditional real estate cash flows and digital credit cash flows. But first, I'm going to send it over to Kenny to give us an update on Westmain storage stacking, as Bitcoin is currently around $73,300 per coin.
Thanks, Tim. Yeah, as of today, our Bitcoin is just over 4 full Bitcoin. We're at 405 million Satoshis. Haven't changed from last week yet. We'll be stacking again tomorrow on Tuesday with our auto DCA. So far in 2026, we've stacked 1.86 Bitcoin, 186 million Satoshis. Brings our year-to-date total, Bitcoin yield total, to 85%. Our Bitcoin per square foot still at 5,838. We should be above 6,000 later this week. We're still holding our stretch, so the ex-dividend date is approaching. We're seeing strategy just hammer the ATM today, looking like $1 billion of Bitcoin raised in just today. We're over 1 year of mortgage payment coverage now with our Bitcoin holdings, so we can cover a full year of mortgage payments. And yeah, we're chugging along. What do you think, Chris?
The improvements continue to come. I think resilience getting built here in real time, week after week. What's the Satoshis per square foot metric up to now? Did I miss that one?
5,883.
Okay.
38. 5,838 Satoshis. So next week looks like, or later this week actually, we'll be above that 6,000. And as I was talking about last week, if you take the total square footage of all commercial real estate, that's 97 billion square feet. And you divide it by all the Bitcoin that will ever be, 21 million. There's only a little over 20 million in circulation now. But if you just take all the Bitcoin that will ever be, there will, the most you would have is 21,649 sats per square foot. But obviously that number is going to go lower and lower and lower as there's publicly traded companies like Strategy, there's ETFs, just a new one from Morgan Stanley last week. So that number just keeps going down and down and down. And yeah, that's going to be the funnest metric to track in the next few years, because people are going to really start seeing what we're talking about when that number just implodes.
If you want more fun, just stay tuned. Just tune in every week if you want more fun than you're having right now. Is that right, Chris?
That's exactly right. Tune in for fun real estate discussions here. We're going to turn everything you thought you knew about real estate upside down and shake it out and put it back together again.
The frog is being boiled.
The frog is being boiled, exactly. Great job, Kenny. Like I said, I think we're witnessing. If you ever wanted to know or ever wondered what resilient real estate and anti-fragile real estate portfolio looked like, this is it, right? You're building it in real time, day after day, week by week. Building your conviction, and it's gonna pay off here in the very near term. Is what I'm thinking. So, congrats.
Thanks, Chris.
I'm excited. I think this is we talked last week about REITs at length, and how they're going to adopt some of these strategies. We talked about Bitcoin adoption. We talked about STRC adoption. and a few other things just tangentially in and around that topic. And today I think we're kind of building on it to some extent. We talked a lot about traditional real estate cash flows, or have been, I should say. Whether that's coming from a Westmain type of property, or coming from a REIT that sits in your brokerage account. And how does that compare and contrast to the income streams provided by these digital credit products, right, that are built on top of Bitcoin? So I'm excited to get into this. I know, Kenny, this is a topic that you've been hammering in the cybersphere quite a bit. So I'm sure you've got a handful of thoughts to share here as well.
Yeah, let's unpack this, because I think there's a lot of nuances that makes it seem like everything, but there's more to it than just that. Like, I think one of the misconceptions that I hear is people think it's just a carry trade arbitrage against the loan and what stretch yields. So just subtracting the cost of capital, and then you're left with like a 5% or whatever. If they're paying 11.5% and your cost of capital is 6%, that spread is what people think. Like, and they're like, well, why can't I do this on my own? Like, why do I need to pair this with commercial real estate? And it's not clicking for them. And like, I've been thinking about that a lot, because if we unpack this, you're trading if first off, you have to have a profitable cash flowing piece of real estate. You have to be producing income. And what happens is most operators use up their depreciation, and they're paying capital gains tax on their cash flow. So like, you're penalized for operating a conservative business that has a low loan to value ratio. So that means you're showing profit, and that profit gets a capital gains tax. And so the big idea here is, well, let's not show any profit. Let's, like, on paper, have like a loss. So like, it looks like your building is actually losing you money. And you know, you want to be kind of like skating by as much as your lender will allow, and maybe you can't get to a loss, a real loss like that, because your lender is going to require you to have a debt service coverage ratio of 1.2, 1.25, 1.4, whatever it is. So you're gonna there's some really bad background noise. Chris, do you want to just mute when we're okay? There we go. So like, you're gonna kind of be like, the lender is gonna dictate how much equity you can pull out, and like, how comfortable they are with what profit margin you need above the debt coverage. So the idea is to be able to have some expenses, or some equipment, or some depreciation to get rid of that last piece. But if you can get your income to show as little income as possible, that sounds like it could be risky. But what we're doing is we're de-risking that by moving that equity, that cash that you pulled out of the property, and you're putting it in something like Stretch, digital credit like Stretch. Now, you have like two components. So you're creating a tax shield, is what you're doing. And you're trading your capital gains income, right? Like ordinary rental income. You're trading that for return of capital, which skips the P&L. It doesn't hit the profit and loss statement. It skips right over that. It's on the income statement, and it skips your tax return. So it's it's basically camouflage for your rental income, because most property owners are conservative. Like, we're conservative. We would never want to borrow and be like, have like a very thin layer of protection. Like, basically all of our cash flow is going to service the debt. Like, that's risky. What if a big expense comes up, right? That's why people maintain equity in the property, so there's cash flow that you can take that cash flow, you can set it aside for a parking lot or a roof repair or HVAC equipment. But this allows you to take out that equity and park it in something that's not only going to preserve your capital, it's actually going to give you a return on your capital, and it's also going to give you a shield from Uncle Sam. You're going to be able to hold up the shield, and after tax, you're going to get to keep more money. So more money goes in your pocket. And we've been comparing our numbers at Westmain from 2025 to what we're projecting in 2026. I think we're going to be doing a refinance here soon. And we are going to have a 60% increase in cash that we keep in our pocket. We're going to pull out something like enough to buy like 12 Bitcoin. We're going to increase our debt by over 100% almost. Yeah, over 100%. So our our debt payment's going to go up to be double. Our taxes are going to go to zero, and our take home pay is going to go up 60%. And we're going to have like 10 or 12 Bitcoin somewhere around there that we extract from that transaction and put it on our balance sheet.
That's all.
All right.
Okay,
Sorry.
let me just take a step back here, right? Because I think you jumped into some really kind of nitty gritty details, and the 301 level class here. So for the listeners that aren't as into the weeds as we are on this topic, I mean, the way I like to think about it, in real estate, we're taught to focus and think about the cash flows, right? But what we rarely question, or we kind of let go in the recent past, is questioning the quality of the cash flow, right? In real estate, a 6% yield is not always 6% income, right? So you have all kinds of expenses and risks along the way that impact that yield, right? That return. So additionally, the real estate income is a combination of a couple of things, right? It's a combination of the rent income, it's a tax shelter, there's a timing component to all of this. And what we're doing here is we're introducing a new income stream, right? The return of capital income stream. Now, the good news for the real estate investors is that this is not new, right? Real estate investors benefit from this for, I mean, as long as I can remember, through depreciation, right? That you touched on that briefly, Ken. The difference here is how it's like how you're receiving it, how it's delivered. So in real estate, your income is tied to the asset, and that capital is locked up inside of it, right? What we're talking about, or what we're kind of bringing, or what we're questioning, is what if we could generate that yield without locking up the capital, right? Maintaining the liquidity, maintaining the flexibility as a real estate investor for if and when that right deal comes along your desk, or to one of your examples, Kenny, you're saving up for a capital improvement, or building up some kind of reserve for any number of reasons. So we're not. This isn't about replacing an income stream for real estate. It's about improving how we're using and holding capital in between deals, right? And that's, we are introducing this new topic of return of capital, dividends, because this is, the fact that it's built on Bitcoin, and it has, in our view, a lower risk profile. This is part of the strategies that real estate investors need to consider and utilize on their portfolios going forward, because the benefits are too good to ignore. So, I mean, Kenny, do you like going back to the traditional real estate income versus the rock strategies, like when you kind of line them all up, right? You got, the structure, the yield components, the yield composition, the tax treatments, the risk profiles, what have you. I look at it like this: the constraint on traditional real estate is that the capital is tied to the performance of the asset and the hold period, right? It's locked up. On the other hand, the advantage of the ROC dividend is that the capital is mobile and liquid, right? You can deploy it whenever you want with a few clicks of a button, and I think that's kind of where you're going with the details you laid out, right? Is you're leveraging this new tool to enhance the financial returns of Westmain.
Yeah, I think, well, to kind of just give a little bit more information on the subject, I think the opportunity is a lot of real estate operators, they have a higher amount of equity in their property than they actually need. They could go to their bank and do a cash out refi, take out the cash tax free, but they don't have a place to put it, right? Because maybe it's not enough for the next project. Maybe they're tired of building more real estate. Maybe they're like, hey, I'm going to need to access that capital, in a year or so. I'm not going to touch it. I'm just going to let it build up there and until I, do this next project. So what happens is, like, it's dead capital. It's locked up and it's not getting a true it's not being put to work, right? Because you only need 25-30% down in the property. That's all the bank requires. They'll let you pull out. And this is if you're just doing traditional lending. I'm not talking about doing any private equity, private credit. And so I think that's how most small mom and pop commercial real estate operators operate. And they're very conservative. So they leave this cushion, they leave this stack of equity, and they pay the price for that because now they're paying capital gains on that income. So what we're saying here is now you have an alternative. You can extract the maximum equity, and it's not like you're being reckless and just putting it in a savings account that is going to melt like a melting ice cube. You're actually getting 11.5% return on money that was basically dragging down your cash on cash return. Because if your equity starts going up above the minimal threshold, well, you're deleveraging. You're deleveraging, like you have like a leverage ratio on your loan to value. And as that equity is building back up through principal like through the principal portion of the loan, um, your cash on cash return is going down. So by placing it into these digital rents, you are shielding yourself from that capital gains tax, right? Because now it's coming to you as return of capital. And that's a feature, not a bug. It's coming back to you as return of capital. It's skipping the P&L. It's not treated like profit, and it's return of capital. It's not income. It doesn't show up on your tax return.
Break that down real quick, right? So, what is that? How does this work, right? For the newbie that's listening to this, and they're trying to understand what return of capital is, right? And then the next thing is, how the heck are they paying 11? What is it? 11.25, 11.5%, right?
11 and a half. Yeah.
Yeah. How the heck are they doing this, and is it sustainable, right? I mean, basically, what they're doing is you give strategy $100, right? They give you back $11.50, right? And they use the difference to acquire Bitcoin, and they take on all the risk and the volatility associated with that. That's really what they're doing. SATA, they're doing the exact same thing, and they're paying, I think, 100 basis points higher, right? 12 and a half, give or take, somewhere in there. So that's really what's happening. So the bet that everybody's making is that Bitcoin is going to appreciate more than 11.5%, 12% per year for the foreseeable future.
So they're doing what real estate guys do. Like, let's back up a second. Real estate was classified as property, right? There's a reason for that. And property is the best classification because it opens the door to be a collateral base. You can now use Bitcoin, and this is ever since it was designated property by the IRS, right? You can use Bitcoin as collateral. The problem is that the price fluctuates, but that's not really Bitcoin fluctuating, right? Like just like the land value does, like the dirt doesn't change in value. The dirt stays dirt. The Bitcoin stays Bitcoin. It's the fiat dollars in the background that are going up and down, right? But the underlying collateral doesn't change. It's pristine collateral. And so if you just kind of remove the word Bitcoin and just use the word property or real estate a lot of the times, everything starts to make a lot more sense what they're doing. What are they doing? They have property. They're borrowing against their property to buy more property. They have developed cash flow, like it's like mineral rights or a building and a ground lease. They're developing on top of the Bitcoin. These financial products, like these digital credit products, they are like buildings in cyberspace. They are paying um, they're leveraging their property and paying the preferred shareholders 11.5% so that they can go out and buy more property to build more buildings potentially, or just expand the buildings they've already built. Maybe they do an expansion and they build right next to it another building with a sky bridge, right? And the thing is you can keep building up. The foundation is strong enough in cyberspace with Bitcoin where you can build up forever. Like you don't have to go pour a new foundation. You just keep building. And so I think what people need to do to be able to understand this is they need to swap out the word Bitcoin because they're prejudiced. They have a bias and they're not admitting to it. They're biased against Bitcoin. But if they had just replaced the word Bitcoin with real estate or property, they'd be like, oh, that makes sense.
Mhm. Can I sidetrack us for a second? So we're talking about digital credit, and Strategy has at least trading volume. Strategy literally just published on X $1.1 billion of trading volume for today. Now contrast that, Chris or Kenny or both of you, with another tweet that says, I remember Tesla buying $1 billion of Bitcoin moved the price from 30,000 to 60,000. Now I realize, end quote, I realize we're in a bear market, or right, the bottom of the bear, give or take. Potentially, nobody knows the future. But like, what's your take on that? Like, you literally have digital credit now buying roughly $1 billion of Bitcoin some days from one issuer. Um, what is that? What's your reaction to that, Chris, Kenny?
Wow. It's kind of crazy when you put it that context. I mean, what's my reaction? This is it's a perfect example of the maturation of the asset class, right? I mean, just a few years ago, I mean, I feel like everybody always says it, but in Bitcoin, we 6 weeks feels like 6 years, right? So to that point, Tim, it wasn't that far back where a participant entered the market and was able to move the price in to the degree that Tesla was able to at that point. And the fact that you fast forward 4 or 5 years and you have multiple institutions buying on a regular, you have ETFs, ETPs in the market, sovereigns buying, in addition to MSTR and the like, and you're seeing the almost the stability, the just this very, very narrow band that we've been trading in, whether it's in the 60 range or when we were doing in that 90 range a couple months ago. The volatility is being dampened in real time. I know it doesn't always seem or feel like that, but if you've watched or you've been in this space for any amount of time, I think it's undeniable to suggest otherwise. Also for to your point, bottom of a bear. I think that's my opinion. We're in the bottom. Um, this is what, a 50% pullback instead of a 75-80% pullback. So that's also very meaningful. And when you zoom out and realize we're 16, 17 years into this thing, um, that's also really, really reassuring. So, what's the volatility look like in year 20 and year 25? My money's on the fact that it's going to be less than it is today.
I mean, my tinfoil hat, starts sparking because, like you said, $1 billion moved the market from $30,000 Bitcoin to $60,000 Bitcoin. I wonder, did Tesla hold its own keys? Did it take the Bitcoin off exchange? The other thing is, Saylor made a tweet a couple weeks ago about there's time from when he said there's time from when I buy the Bitcoin and Bitcoin goes to the moon. And I think part of that is, okay, he's issuing shares of Stretch into the market today, but that money has to settle in his account before he can go and transfer it to Coinbase or wherever he's buying his Bitcoin, right? Like there's a slight delay. So like, yeah, that's probably how much Bitcoin he's going to be able to buy, but he actually has to go and like move the money, and you know those are kind of the internal things that we don't get to see or um, like understand that well. But there is time from when he issues the shares to buying the Bitcoin. It's not like you issue the share and then boom, Bitcoin. Um, but the tinfoil hat, the reason I say that sparks is because there's been talk about rehypothecation forever. Do the exchanges have the Bitcoin on the balance sheet? And this is why self custody becomes important. There's um, a reason why Bitcoin is valuable, and one of the main reasons is self custody. Like we're seeing talks of the Strait of Hamas in Iran, they're accepting Bitcoin. They're not holding it on an exchange. They're not taking stable coins that Tether can freeze. They're not taking US dollars. That means there's no sanctions that the US can impose on Iran at this point. If they're taking Bitcoin, it's permissionless. They don't need a Coinbase. That's what people don't get. You can just go run the software. I don't need Coinbase. I can run software and take Bitcoin as payment without an exchange. There's nothing stopping me. It's just code and software. And so I think, maybe there's something there. Like maybe there's like some paper Bitcoin going on. Maybe Sailor should take a portion and have the strategy team do a multi-sig internally. And like, yeah, like I know like they can have a portion at Fidelity, portion at Coinbase, and they can have these different baskets of Bitcoin. But maybe they should have a basket of self-custody that's multi-sig from within the company, or a multi-institutional. We had Jackson from OnRamp on at one point talking about multi-sig custodians, and I think there's other players in the space, Anchor Watch or something like that, and there's opportunities to test these exchanges, to withdraw from these exchanges. Let's see what that does to price when we see the transaction in the mempool pending, when we see it get picked up by a miner, and then guess what? It's part of the time chain. I think when we see that, the shorts and the paper Bitcoin people, they get spooked, because guess what? It's moving off exchange. We've been seeing exchange balance at 2.5 million Bitcoin for like 10 years. What's going on?
Yeah. Kenny, 1 minute ago, Saylor posted $1.156 billion of liquidity, 1 penny of volatility, closed at par, STRC. Your reaction, Chris, your reaction?
It's working as designed. Um, yeah, it's working as intended. I mean, he was gonna he wanted to strip out all the volatility and trade in a really tight band, and you're seeing him accomplish that in a very short period of time. It's been around what 6 7 months or so. So congrats to him and the team. Kenny, I appreciate you bringing up those points. I completely agree. With the paper Bitcoin comments. I mean, I think it's very naive to think otherwise. With all the exotic instruments and options and different vehicles that are available today, that's definitely above my pay grade. But I think it'd be silly to think that there isn't some level of that. And the other thing is the importance. It goes back to the importance of self custody, which we've hammered on the show before, and it's more important than ever. I think I've even said it in the past when talking to real estate people about holding Bitcoin, and one of the biggest pieces was don't buy an ETF. Like, you are defeating the entire purpose of the strategy. So make sure you're buying real Bitcoin. Make sure you're spending the time and effort to figure out your custody and security model for the day when the day comes that what Kenny just described. The markets have no idea. Uh, they haven't thought through what the implications of a bearer instrument that can be self custodied have on these markets. And when that tripwire is tripped, right, to Kenny's point, you're going to see some face melting runs.
I mean,
There's no on off switch, right? To your point, Kenny, there's no on off switch. So when COVID hit, in March 2020, and they kept hitting the circuit breaker. Oh, down another 20%, hit the circuit breaker. Down another 15, hit the circuit breaker. Just let's pacify the market as much as we can. That doesn't exist in Bitcoin. So do your homework now. Have a sense of urgency, and just eliminate that risk altogether.
I mean, just going over this with you guys right now, it just popped in. It just occurred to me, like, Sailor's got like an ace up his sleeve, a huge one, right? Because if he wants to destroy the shorts at any time, he could withdraw almost 1 million Bitcoin off exchange. What will that do to the shorts? They would just blow up. That would be a god candle to like $10 million. Game over. Checkmate. Like, I mean, the longer he keeps it on exchange and then rug pulls the exchange, like, you could see exchanges go, Coinbase might go to zero, right? What if they can't deliver?
None of this is financial advice, by the way. But in all seriousness, bringing it back to the real estate topic here, I think what you're saying, Kenny, what I'm saying, kind of from different vantage points, is it underscores the broader thesis, the broader framework that that we're building this thing around, and that is the fact that real estate investors and operators need to rethink the playbook. Right, we've hammered that one home, and there's now three buckets that they can deploy capital. Right, you have the real estate, you have Bitcoin, and you have STRC. Right, and what this allows you to do, I should take a step back. In our opinion, Kenny, correct me if I'm wrong or you disagree, but in our opinion, in today's market environment, the highest and best use of your capital is to accumulate as much Bitcoin as you possibly can. Right? So whatever that goal is for you, 1 Bitcoin, 10 Bitcoin, 1,000 Bitcoin, whatever that is, do everything you can to get to that goal. Right? The second objective is to preserve your liquidity via STRC, so that when there are dislocations in the market, when there are good opportunities that arise in the real estate world, you have the ability to move and capitalize on those. Right? The I'm going to say, this is kind of like, I don't want to say dirty word, but it's frowned upon in the real estate industry, and I'm just going to say it. But it's no secret that the industry is, there's some misaligned incentives, right? It's structured around deploying like deploying capital in very finite periods of time, right? It's not about necessarily optimizing your timing or optimizing the assets that you're acquiring, right? So that pressure alone, whether you're an acquisition team or a fund manager, whatever your role is, right? If you're given $100 million to go build out a logistics portfolio and your compensation is tied to being able to place that capital on a finite period of time, you're probably going to buy some deals that you wouldn't otherwise, right? So what we're doing here is we're thinking about it differently. We're giving ourselves the ability to be patient and intentional about what we buy in the real estate market and when we buy it. And how are we doing that? We're doing that by utilizing Bitcoin and digital credit. The digital credit is kind of the first line of defense in that strategy, because you have the cash flow, because you have the liquidity, because it's not a finite resource, right? There's more than 21 million of it. So you spend your STRC first before you spend your Bitcoin stock, or at least go to that. So that, I think, is what we're ultimately trying to get here with this entire discussion, and even the entire podcast, is furthering this conversation in the space about the new tools that are available and how you can use them to your advantage wherever you sit in the industry.
Yeah, I think you did a good job summarizing that, because that's something I often overlook, and I expect everyone to kind of know that, and I kind of take it for granted. But one of the things you've been consistent about delivering on this show is that wait for the opportunities on the courthouse steps, right? I just got a call from a lender, and there's a self-storage facility that they lent on to a first-time operator that's in our 100-mile ring. So it's not like our immediate competition, but it's in the 100-mile ring. So it might be something that we would operate, right? If the opportunity was right. And so I think those opportunities are starting to show up. We've seen the holes with private credit, but I'm starting to see it with these real estate deals. So I may have a lender that's like, here, just take it over. We don't need a down payment. Just take it. Just make this thing work. Save our ass. And these are the kind of deals that we're waiting for, and that Chris is talking about when we say, a better use of capital, get it out of the property, make it liquid so you're ready to strike. Because one thing that does is, now you don't need a contingency on financing. If you have a big stack of digital credit, you can just sell the digital credit and go buy it, right? And the whole time that you're holding that, you're getting 11.5% return on that money. So you're not in a rush, like Chris is saying. You can be very selective. You can wait for these bankers to call you up and say, hey, we got an opportunity. You only need to put 10% down on this. We screwed up, and we really want you to take it over. You guys know what you're doing. And
that sounds ideal.
By the way, you're getting it at a basis that's 85% less than the last one.
Well,
Right?
and we're looking at taking this. We're like this deal that just came on our desk. We're looking at taking it, one, because it's not going to cost us anything. Two, we're looking at a future, right? Like we're building our self storage facility to be future resistant. So that means on demand self storage is coming. Like we have to be thinking of providing on demand storage. Like in the future, I want to be able to send a self driving Tesla to your house with the Optimus bot, and have that bot move all your stuff into the car and deliver it to our facility, where another bot unloads it. And we have EV charging stations for the vehicles. We have solar panels to power the EV charging. And now our flagship location is got the location, right? So we get the walk-in traffic, we get the drive-by traffic. But people that don't need to access their unit, we can offer them a discount and we can send this 100 miles away, store it over there where land is cheap.
Mm. It sounds like you're describing, when you include the digital credit, the three perfect products from Sailor. We are going to not just take our time, Kenny, but slow this down and take a quick break, and we'll be back in less than 1 minute. Quick note for property owners listening to the show. If today's discussion sparked questions about how these strategies might relate to your own building or portfolio, we're always happy to have a conversation. No sales pitch, just a thoughtful discussion about your property, your capital structure, and the options available in today's market. You can find our contact information in the show notes. All right, we're back. That was Tim in the studio. Now it's Tim, Chris, and Kenny in the office. Where were we, guys? Did we want to share that one presentation, or we're just using that as notes in the background?
No, I think this is probably a good time because I think we've hammered the concepts a little bit. I want to maybe connect these concepts with some numbers. I think that may help people kind of wrap their head around what we're talking about here and just the sheer power of the strategy. So let me share my screen here. Let me know when you guys see that. Okay. You got that?
I see it.
Okay. Perfect. So what I did here, I ran two different kind of scenarios, right? I kept the numbers small. I kept the scenario very, very simple just for, explanatory purposes. But I wanted to see what the overall outcome would be, over a 10-year hold period using traditional real estate versus a digital credit product. So on this left side here, the traditional real estate example, this was under you can see the assumptions here, right? A $1 million initial investment, 6% going in cap rate, 3% growth, 5% exit cap. Whether or not you agree with these assumptions over this time period is not what I'm necessarily concerned about. The fact of the matter is this is pretty darn standard across the industry. This is what your acquisition guys and real estate teams, investors are looking at and dealing with on a daily basis. So you're basically looking at a 60,000 year one cash flow, right? We're compounding that 3% a year. At the end of 10 years, you got just under $700,000, 687 to be exact. The exit value after year 10, you got about 1.6 million in change, right? So after you account for taxes, your net proceeds are anywhere from 1.35 to 1.4 million dollars. So between the cash flow you received over the hold period and the net sale proceeds, your total value is just over $2 million. Okay, and that is assuming everything went perfect. Right? You didn't have prolonged vacancies. You didn't have any unexpected capital expenditures or any unexpected maintenance or repairs. Right? Your CapEx plan went perfectly. Ideal scenario. Alternatively, you could have taken that same $1 million and bought a vehicle like Stretch STRC. Right, I assumed no volatility, no growth in the principal, 11.25%, and we reinvested the dividends over the whole period. You got just under $3 million, so you're about 50% plus or minus better off from a financial standpoint. Meanwhile, you maintained your liquidity the entire time. You were a lot more efficient with your capital, and you were able to be patient and wait for that right real estate deal to come across your desk. Now, let me just to kind of illustrate on a graph here, right? Your orange line is your digital credit versus your traditional real estate in blue. So I don't know about you guys, but all else being equal, I'm going to be focusing or at least figuring out how to incorporate digital credit into the operations at the very least. The other thing I've said in the past too is if you're a real estate operator and you think your competition is the building next door, right, or the city that you live and work in, you've already missed the boat, because these products are also your competition, right? If you're trying to source capital for your next fund, right, and your LPs have the ability to choose between your 6% vehicle, illiquid vehicle, and a 11+% liquid vehicle, where do you think they're going to put their money? Right. So again, your competition has expanded, and it's not just the neighborhood or the marketplace that you're operating in. So I pulled out. So let's just say let's just play out a hypothetical scenario here. You have your 10-year hold. Your cash is in the STRC vehicle, and at year 5, there's just an unbelievable real estate deal that comes across your desk, right? Because you have your capital in a liquid vehicle like Stretch, you're able to move and capitalize on this opportunity. So at the end of year 5, you got about 1.7 million bucks, and we're going to assume you're going in at a 8.5% yield, 3% growth over a 5-year period. Those are really conservative numbers. Kenny, check me if you disagree, but I think that's really conservative. Once you do the same calculations at the end of year 10, you end up with $3 to $3.2 million versus the 2-1 you'd have if you were just a traditional real estate guy. So if we put that, there's not a huge difference here, but there is a little bit of an advantage here on the long end with the distressed opportunity. But I mean, look at that margin between traditional real estate and return of capital strategy.
Yeah, and I think you're being very conservative because I don't know what you reinvested the income in, if it was more strategy stretch, or if you have like this third bucket that we were talking about Bitcoin, it gets even better, right? And the one thing on the real estate side, I don't know if you accounted for depreciation. I mean, that does have a
I did account for the taxes. Yep, the depreciation
and
recapture on the exit.
and is that with having a certain loan to value, like the $1 million? Is that like straight cash buying a?
Just for simplicity purposes, for illustrative purposes, I just used all cash.
So
So
I would push back. Like if I were gonna be a little harder, I would say, well, you gotta divide that by like 3 or something. So you're actually getting triple that. But
fair.
I still think you blow that out of the water. Because I've run similar numbers as you, and the rock strategy outperforms traditional buy and hold real estate. It outperforms even sometimes distressed real estate. But you can definitely find that's the benefit of having the time and the selection to make sure you acquire the right property, and that you don't, if it's not going to outperform, maybe you say, hey, why do I want the headache if it's not going to outperform, and you have a new hurdle rate. Um and like, I think this is conservative, because if you add Bitcoin into the mix, it blows both of those out of the water, right?
Yeah, you're exactly right. This is extremely conservative, and it doesn't take a handful of these other assumptions into account. You can add Bitcoin into it. You can also add. I mean, we talked about this a while back, but what if you allocated a small percentage to something like STRK, right? You had the appreciation potential there, right? You're still clipping 8% along the way. So again, this gets really, really, really interesting very quickly. So to your point, I think you said it really nicely there, Kenny. I think I've heard of a podcast with that title somewhere before, but the hurdle rate has moved. And if you're not paying attention and you're still allocating capital based off of, whatever the clowns tell you CPI is, then you're not going to be competitive for very long. So the way I think about my hurdle rate, it's Bitcoin's my hurdle rate.
Well, the other thing I'm going to add here too is this is before tax, right? Because
Yeah.
you didn't get into taxes. So you know what? The real estate is actually going to be even less because the rock is return of capital. You're tax deferred until you get all your money back, and so not accounting for the leverage probably wipes itself out.
Yep. Yep.
So I mean, to your point, if you're a real estate guy raising capital to go buy real estate and you're going to start seeing people willing to outbid you and you're not going to be able to figure it out. You're going to be scratching your head. Why is this guy overpaying for real estate? And it's going to be simple. The cash flow and the equity in that property is worth more to an operator that understands Bitcoin and digital credit because it's like the difference of understanding private equity and private credit, right? Like those guys can leverage up the property a little bit more. I never really knew about those tools until going down the Bitcoin rabbit hole and then ultimately going down strategy and becoming more in tune with um, preferred equities and everything of that nature. And it's like another tool for real estate operators to have edge. It's going to create an unfair advantage. If you're going up to somebody that doesn't use Bitcoin and digital credit, it's like you can tie both of your hands behind your back and still beat them with a headbutt. Like because you're just going to be so much more powerful and you're going to have the liquidity, you're going to have the strength, you're going to have the dual collateral, you're going to have so many more options. You're just going to so yeah, I think I'm repeating myself, but I appreciate that presentation because no matter how you spin it, Bitcoin wins.
Yeah. Absolutely. There was Marty had TFTC had a really interesting episode. I think it was last week, maybe the week before. The gentleman's name was Nick Nemeth, Nemeth, and he's been doing a lot of like almost like investigative financial investigation work, from what I gathered, on the insurance companies, the reinsurance companies, and just the overall financial condition of those entities. If you didn't listen to it, it's definitely worth the hour and a half listen. It was really, really fascinating, his perspective and his findings. And the reason I bring this up is when you really get into it and you understand all the risk that's out in the system, how much financial engineering has taken place, how distorted and overvalued these assets are, right? Whether it's an office building or a retail center, apartments, what have you, this strategy becomes all that more appealing because we have not, if this Nick Nemeth is 10% correct, right? 10% correct. There is a absolute tidal wave of distress coming. How long does it take to play out? How to what extent is it allowed to play out? I don't know, but if you're going to, if you're playing in these markets, you need to have a very uh, robust strategy, right? And that's where these tools come into play, right? Whether it's Bitcoin or STRC, because if it were me, I'm not buying any real estate at quote unquote fair market value or any kind of discount less than 50%, right? Like if it were me, I'm, spinning up a new fund, my buy box is minimum 60% under fair market value, right? Because there's the financial distortion that's baked in there, and then there's the store value premium that Bitcoin is absorbing. So I want to be super, super patient. I want to buy deals on the courthouse steps, like you mentioned, Kenny, for pennies on the dollar.
I want to be ready for the banks to hand them over. Hey, you know how to operate these assets? We got a first timer that fucked up. Sorry for my language. Here, take the keys. Go operate the business. And we don't even touch the stretch. It's sitting there spitting out cash flows, and we just took the keys to a new facility, and we're going to operate it better than any other operator can. So I think you're right. I think you know real estate moves a little slow, and Bitcoin moves so fast, they kind of like level themselves out. But
Yeah.
yeah, we're going to be positioned to take advantage of these opportunities, and they're obviously coming. Like, the writing's on the wall, and we just need to be there and be patient, and stretch allows you to be patient. So I think that's like the huge takeaway.
Any closing thoughts before we wrap this up, gentlemen?
Yeah, I'll go first. Sorry. um, you talked about Sailor, and have a robot that serves you, have an asset that pays you, that kind of thing, and also the $1 billion a day demand for Bitcoin through Stretch. I was thinking about that. That's what, a half a trillion a year, 52 weeks. That's going to be like 520 billion a year is what he's going to be able to acquire just from Stretch. So yeah, I think it's going to be a tidal wave of money coming in after a tidal wave of distress.
Can you break that number down real quick, Kenny? Did you say 520 billion a year, or did
Oh
I
yeah, that
mishear
would
that?
be yeah, that would be. Did I do the math wrong? So 5 billion a week times 52. It's actually more. That's trillions of dollars. My math was very bad there. Thanks for thanks for clarifying. So what is
Five
that? So
5 billion a week times 52 weeks would be 260 billion. Is that
We got Tim on the calculator over here.
are
In the
we
background.
making sense, Chris? 5 times 52 is 260.
There you go.
If you do an average of $1 billion
yeah, but
a day. Yeah.
okay. Yeah, I think my math was off. Or is that yeah.
So if you do 2
uh,
billion a day on average, and rough numbers, right? Because you have holidays, but that'd be 520 billion a year, over half a trillion dollars a year flowing into Bitcoin. So if that's not bullish, I don't know what is.
yeah,
Chris,
that what is
closing.
what is that's a
Go ahead.
huge percentage of the market cap, right? Like
Yeah.
for like
Um,
one
clo-
good.
Closing thoughts. I think we did a really good job today beating this one into everybody. But in this market, regardless of your opinions on Bitcoin or digital credit, in this market, timing, liquidity, and just tax efficiency, capital efficiency matter like more than anything. So I would urge you to just reconsider any prior assumptions or frameworks that you've used in past cycles. because things are changing incredibly fast, and we've barely even scratched the surface on today's show on as far as what all that entails. So proceed accordingly, and check your priors.
Awesome. Well, that's it for today's episode. If these conversations are useful and helpful, please share the episode wherever you find it on social media. Share it with a partner, a client, somebody making decisions in the marketplace. New episodes of the Real Estate Podcast drop weekly. So like, subscribe, comment, do all those things, and help us create that conversation. So until next time, stay disciplined, think long term, and stack sats. This is the Real Estate Standard Podcast.